Our next guest has built a legacy with one of the most successful companies in the mining sector in the world. Pierre Lassonde joins us today. He has built Franco-Nevada up from the ground up, and today he talks to us about his experiences and what he sees next for the industry. Pierre, welcome back to the show. It's an honor to speak with you today.
Well, thank you very much for having me. It's always a pleasure.
Always a pleasure to have you, Pierre. We want to start with just a macro update. We have so much to discuss, but a lot of our investors are wondering what miners in the industry are thinking about the price action we've been seeing over the last few months. Last time you were on the show in April, gold was trading around $1,600. At over $2,000, gold prices have really expanded. Have you seen margin expansions as a result in the industry?
Yes, absolutely. And this is very comparable to the kind of margin expansion that we saw in the early 2000s. Don't forget, gold bottomed in 2001 at $250 to rise to $1,900 by 2011. So the rise in gold price, everybody thought would lead to enormous margin expansion. And the stock went up in 2003, 4, 5, 6, 7. And then all of a sudden, they all plateaued out. And then finally, they turned around in 2011, and they never got the kind of multiple that you were expecting because there wasn't any margin expansion. And there are two reasons for that. One is the oil price kept going up. And energy, as we know, is 25% more or less of the cost of operating gold mines. So as the energy price went from $25 a barrel to $140 a barrel, the margins were not expanding as fast. And then because during the late 90s, the gold price kept going down, mining companies essentially stopped exploration. And when the gold price started to come around, what they did, because they didn't have any reserve, they dropped their cutoff grade. And so they were producing the same amount of gold, but moving twice as much dirt. And that too costs a lot of money. And you had no margin expansion. The difference today is very, very different. Number one, because oil prices are flatlining. When you look at oil price today, $37. But when you look at the oil price for the next year, you can look at the contango, it's almost nothing. You can look at 2 years out, it's almost nothing. So the market is telling you the oil price is well fed, there's enough oil out there, and it's going nowhere. So that's a 25% component of the miners, of their costs. And then the other thing is that in the last 20 years, in terms of cutoff, gold miners have decreased their cutoff to the point now where open pit mining, they're down at 0.05 of a gram in terms of cutoff. Well, the next cutoff is dirt. Okay, there's nothing left. All right, so the open pit miners don't have any ability to increase their reserve, even if, because they can't cut their cutoff grade anymore. They're down. So that's a good thing, because it means that as the gold price goes up, that difference will go right down to the margin, and you are seeing margin expansion. The gold miners today have never had it so good. The margins that they are producing are the fattest, the best, the absolute unbelievable margin they've ever had, ever.
So I guess an investor who is new to the space is probably wondering, gee, have I missed the boat on mining stocks since margins are at the best ever? Or is this the right time now?
Well, I think the answer to that, David, was provided a couple of weeks ago when Warren Buffett bought $500 million worth of Barrick gold at today's price. And what is Warren Buffett seeing? This is not an individual that bets on the gold price. He doesn't bet on commodity. What he's seeing is that he can buy Barrick at a fraction of the kind of multiple that he believes is the right multiple. So no, you haven't missed the boat at all, even though the gold stocks are up double from the bottom. But you got to think, at the bottom, 6 months, a year ago, the stocks were so cheap, but nobody was interested. Nobody was interested. It's the same old story in our space. At the bottom of the market, there's never enough money. And at the top, there's always way too much. And we're barely off the bottom at this point in time. And there's a lot to go before we reach the top.
With margins at the levels they are now, one would expect exploration activity to pick up significantly. Are you seeing a lot of that this year?
We are seeing some, but the exploration activity, the majors are obviously ramping up. But don't forget, 50% or more, 50 to 60% of all exploration activity is by the juniors. And in terms of the junior sector, it's been risk off now for the past 6 years. That is, they've not been able to get any money from the market. That too is changing. And I think that over the next 6-9 months, you're going to see more and more juniors coming to the market doing $2, $4, $5 million kind of raise. And I would say that by next summer, I would not be surprised if we were to see exploration budgets up by anywhere from 25 to 30%. And the year after, I think the budgets will be up more likely by 50 to 75%. I do believe there's going to be a big increase in exploration budgets over the next 2 years.
Where's the funding for this increased budget going to come from, Pierre? Is the sector attracting a lot more capital at today's prices?
It is, and not to the level of the kind of frenzy that we saw back in 2011. But we are starting to see inflow. Now, you just have to watch the public gold funds to see if the money is coming in or not coming in or going out. And for the past 7 years, essentially, money has been going out. For the last 2 years, money has been flat. And now they're starting to see inflows. And that gives you a pretty good idea of where the money is going. And then if you look at gold itself, you just look at the gold ETF. Look at GLD. GLD is up over 900 tons this year alone, which is the biggest. They've had more inflow of money in the first 9 months of this year than any year in the past 16 years. It's been public since 2004. So it's a record inflow of money into the gold GLD. And that's also a precursor to what's happening in the equity sector.
Okay. Pierre, you've worked with a lot of different mining companies throughout your career, and you've seen different cycles of gold and silver prices. Let's take 2011, for example, the last time we saw prices at current levels. When prices were that high for gold, did you see miners still exercise the same level of fiscal discipline as you would expect in a lower price environment, or where they say maybe, okay, well, prices are near $2,000, I have more room to spend now. I have a little more room to bump up my all-in sustaining costs because, like you said, margins are so high, it doesn't really matter. I can just spend a little more. Have you seen some of that happen?
Not yet. And you're absolutely right to point that out, because what happens, again, when money starts to flow over the top, essentially people are saying to mining companies, we want you to grow. And we don't, really care about the margin. We want you to grow. And what do the CEOs, they respond to what their shareholders are asking. So they started to do, back in 2010-11, frankly, stupid acquisitions that then they took 7 years to pay off or regret. And now everybody has come full circle and they've all said, mea culpa, mea maxima culpa. I'm not going to do it again. But believe me, I'm an old cynic. I've seen 7 of these cycles. And when the money starts gushing in, it will be very difficult to resist the temptation to go on the M&A path. Very, very, almost impossible. It will take discipline, iron discipline that few CEOs have.
That's it. So are we going to see the shopping spree this time around, you think?
Oh, of course we will. Of course we will. And the main reason, David, is very simple, is that most companies, if you look at Barrick, you look at any of the large companies, their reserves have been declining now for the past 6 years. And yes, they can start drilling, but the brownfield exploration that will bring up that will give you the ability to lower your cutoff grade. We're reaching the geological boundary. So where do you have to go? It has to be greenfield exploration, and greenfield exploration is before you find, prove, build, develop, and put it in production. You're looking at 7 to 11 years. And if the gold price is $2,400 next year, what do you think they're going to do? They want to buy. They want the growth today. They want to be able to have this project in production next year or the year after. So obviously, we're going to see M&A in the space. And I think the way you're going to see it is going to be sort of like 3-tier. That is, if you got a projects that have 1 to 3 million ounce of reserve capability, you'll get offers at par. If you have 3 to 5 million ounce of reserve capability, you'll get a premium. And any projects that is from 5 to 10, 15 million ounces, there'll be bidding war for those. That's what I see.
You've talked about mining valuations. You've talked about mergers and acquisitions. Let's talk about the gold price itself now. We've talked to you before about this, and you had given $20,000 price forecast based on the Dow to gold ratio. Have you updated your view since then? Has the coronavirus, for example, changed the way you perceive this ratio? Are we still going to see potentially a reversion to one to one, you think?
It's interesting because a year ago when we were talking about the gold price and I mentioned the Dow-gold ratio, I did not know why it would go to 1 to 1. It was still hypothetical in my mind. Like, the ratio has been 1 to 1 twice in the past. I think we're going to get, and then, it takes a 40, 50-year period. If you look at 1930, 1980, well, we're now at 2020, so 40 years. So sometime in the next 5, 10 years, I think we're going to see 1 to 1. But I didn't know how we're going to get there. Well, with COVID, I think I've seen the answer in a sense that when you look at our neighbor to the south, the Federal Reserve, they are printing, like $3 trillion. They're talking of another package in the 1 trillion to 2 trillion. You look at what's happening in Europe, 700 billion of package of rescue, another 100 billion in France this week. You look at Canada. I mean, it seems that Mr. Trudeau loves to write checks left, right, and center. We're going to reach over $1 trillion debt in Canada. So that money, unlike 2007-8, which ended up staying in the banks and never went into the public, this time around, the difference is that the money is sent by checks directly to people. And it's part of the reason why the stock market is where it is. Because a lot of people have gone on to Robinhood, the new platform. They're playing the stock market because they got nothing else to do. They're at home, they're stuck. And you're seeing that money being spent, and I think at the end of the day, it will create inflation. And the other side of the coin is the amount of debt that is being taken on by the various countries. It'll never be paid back. So how do they not raise taxes? Well, they don't have to raise taxes. The money is zero if you keep interest rate at zero. And that's what the Federal Reserve is doing. And that's what Japan has been doing for 20 years. Japan's debt to GDP is 230% going to 300. But they don't have to ever pay back the money because it's zero interest rate. In Germany, it's minus, it's 0.7. And that's what's going to happen in the US. We're going to end up with negative interest rates and possibly in Canada. And government don't care. They can borrow all they want.
So this 1 to 1 ratio that you were talking about, is that going to come from the gold side? Is gold going to go up or are stocks going to collapse?
I don't know.
Maybe a bit of both.
It's instructive to look at the past. because the twice when it's happened for a very different reason. Back in 1933, the Dow lost 90% of its value between 1929 and 1933. It went from 360 to 37. The gold price went from $20 to 36. Okay, so the gold price almost doubled, but the Dow itself went down 90%. In 1980, the Dow had gone down from essentially 1,000 to 600 from 1966 to 1980. It came back up to 800, but the gold price, as we all know, went from $35 to 800, which is 24 times, from the beginning. So very, very different response at different times. This time around, it's hard to say, David, because with the money that's floating around, it's hard to see the Dow going down to like 10,000 or 12,000. Could it happen? Yes, but I find it very difficult. Could it go down to 20? Very possibly. 17, yes. 15? Could the gold price go up to 15,000? Absolutely. That's what I'm talking about. But I don't think it's tomorrow morning. I think it's sometime in the next 5 to possibly as long as 10 years.
Well, let's say gold goes to $15,000 or $20,000, which is what you had assessed earlier. How would the industry change fundamentally? Are we going to see major restructuring? Are we going to see a major shift in priorities?
The key question here is how long is it going to be there? Don't forget that in 1980, the gold price was 800 for less than a day. Okay, let's be serious here. If you look at the entire quarter, the gold price was about 675. And if you average out for the year, it was less than 600. So yes, it did go to 800, but it was there literally for a day. Okay, now, and in 1933, though, it went on a little bit longer than that, but it was certainly less than a year. I don't have the detail in front of me, so I can't really tell you, but I think it was, probably closer to like 3 months or something like that. So the key question is, how long will that ratio be 1-to-1? How long are we going to see the gold price at these, crazy numbers? And then what will be the inflation? What's going a dollar be worth? Don't know. Who's going to be the next president of the United States? Is if Biden gets in and they decide to, do the kind of medicine that we have in Canada, the costs are just going to blow out. They're going to have to print more money. All of that is going to fuel the gold price up. We don't know. It's too early.
Absolutely, yeah. You brought up a lot of good points here. Let's move back to royalty companies now, because you are one of the world's foremost expert on royalty companies. Do you think that this new higher price environment has changed the preference for royalty agreement types, like net smelter agreements, net profit interests? There are different royalty types. And do you think companies have different preferences at different price levels?
No, I don't think so, because the royalties are very much function of what it is that the company, what stage the company is at. Is it an exploration company? Is it a development company? Is it a company in production that wants a cash payment? And then the quantum, the size of the money, the need for the company. Like an exploration company may only need $20 million to be able to, finish drilling and get a pre-feasibility study done. At which point you don't have enough information to do a streaming agreement, so you end up doing a straight NSR. But if you're building a mine and you need $500 million, well, that's a whole different story. Now you really need to build a streaming agreement, but at that point you have all the data to be able to do it. So the gold price itself doesn't really affect the way you transact, except at the end of the day, the price you pay.
What about interest rates, Pierre? We're seeing very low rates right now, historic levels of low, negative real interest rates. Would that be competition for royalty companies, do you think? If a junior miner were to find financing, he would say, the CEO might say to himself, well, I can get very, very attractive rates from debt. Why would I have to go to a royalty company to finance my agreement? How would you respond to that?
Well, good luck. The reality is that the banks will never fund you more than like half of your project. And then for the rest, they say, okay, go get equity because we don't want to be exposed to more than 50%. So the plain reality is that even though interest rates are very low, the banks are still incredibly reluctant, one, to even lend to the mining industry, and two, to be anywhere near 50% on the hook for the entire capex. So that's not going to change the structure of the industry or the lending, if you want, not at all.
Okay, and what about the COVID environment that we're seeing this year? Has that changed priorities for CEOs? Do you think? I mean, we're seeing different jurisdictions around the world emerge and recover differently in response to COVID. What new risks are they seeing? How are they responding? How are they changing the priorities, do you think?
I was just looking at one of the bank produces a account of all the mining sites that have been impacted around the world, and it's over 372 so far. And how many are still down? It's about 70. Everybody else is back in the production. So what we found out in the industry is that COVID has been an equal opportunity killer. It goes around the world, and it doesn't discriminate, and it doesn't mind. It doesn't care if it's in Peru or if it's in Zambia or Canada or whatever. And the mining industry has been impacted equally everywhere. And I think it's just one of the risks that as an industry you have to deal with. Just as you would have with drought or too much water, or any other environmental factor that we deal with. Yeah. So at the end of the day, COVID has not. I mean, if you have a great mine in a country that's currently impacted by COVID, you'll still build it, because at the end of the day, a good ore body trumps everything.
Pierre, this isn't just a year of change for the whole world. It's also a year of change for not just the industry, but yourself as well. You've recently stepped down from the board of Franco-Nevada. How do you feel? How did that make you feel?
After 35 years of being intimately involved in Franco-Nevada, from starting the company with my partner with $2 million to building it to a $36 billion juggernaut, it's been a great and fantastic story. But there comes a time where you have to, make place for the next generation and move on. And I realized that a couple years ago, and I decided, 2020 will be the year. And in the background, I started building a little merchant bank. And one of the fellow that was working with me at Franco-Nevada joined me, as well as two bankers from GMP. Rainmakers, and started Trinity Advisor, and we got going and doing deals.
You're also involved in Orla, right? Tell us about that.
That's correct. We started that 4 years ago with nothing, and bought a company, the public company, that was not doing too well. And then Goldcorp was disposing of assets in Mexico, and we raised our hand and said, "Yeah, that sounds good to us." And, David, I love optionality. So in Orla, we have a project in Mexico, Camino Rojo, that we're going to put in production, the oxide part of it, 2 million ounces on surface, 1-to-1 strip ratio, good stuff. But underneath it, there's 8 million ounces of sulfide. And at $1,900 gold, that also all of a sudden becomes worth a huge amount of money. And and there's been 300,000 meters of drilling done on this thing. So it's not exactly like, it's unknown. I mean, there's so many holes that when the wind blows, it whistles. Okay. So this is something really big. And we're looking at what we can do with that. And then in Panama, we have another deposit with 1 billion pounds of copper that we're just starting drilling this week to increase the size. So I love that exposure. I love that optionality. The stock has done quite well. It's gone from essentially, 50 cents to over $5. But it's nowhere near its full potential. So I'm very, very pleased. It's been, and we have a great CEO, Jason Simpson, who used to be at Torex, built Torex, and now he's with us. He's building Orla, and we have a great chairman, Chuck Jennis, who used to be at Goldcorp, who used to be with Glamis. So we got experienced people, great deposit, and that's how you create the magic.
Yeah, but Pierre, you've built already so much in your career, more than most executives. You've retired from Franco-Nevada. Some would say, well, why don't you just go to a cottage and relax? What drives you? Why are you still so active in the space?
Because I'm having fun, because I love to help young entrepreneurs. I get a real kick out of that. I get a real kick of having all these young people around me, all fired up. They want to create wealth for themselves, for their shareholders. And, we're also helping America Gold and Silver. That's another company that I've got a bit of an involvement in. And I just love being able to do that. Much better than putting your feet up and watching the day go by. That's boring.
You were telling me Franco-Nevada market cap around $36 billion, 36 employees. That's roughly $1 billion per employee. That's more than any other company that I can think of. Actually, it was E.B. Tucker. I spoke to E.B. Tucker just before you who brought that up to me. That's incredible. That's incredible.
It is quite incredible. The Franco-Nevada business model is absolutely, bar none, David, the best business model ever invented. And think about this, okay? Just to give you a quick synopsis, when we bought back Franco-Nevada from Newmont, we sold it for $3.2 billion. We bought it back for $1.2 billion in 2008. It had 20 million ounces of reserve, 30 million ounces of resources. 10 years later, that 20 million ounce has been mined. So you say, what's the reserve today? Well, it's 20 million ounces, and the resource is 30 million ounces. And how much did Franco have to pay for that? Bupkis, zero. And that is the optionality embedded in the Franco-Nevada business model. And that is why it's such an incredible business model. Because the value of the company is not just the cash flow like you would have in a regular company, the net asset value, the discounted cash flow. It's that embedded perpetual option on the discovery made by the operators of our property. That's the real value.
It's important for our viewers to know, because not everybody might know this, is Franco-Nevada wasn't always a royalty company. You started off as an explorer. At what point in the 80s did you and your partner decide, you know what, let's abandon this model, let's do this? Because that was a relatively new concept. It's been done for oil and gas. It's not been done for mining before, in precious metals at least. So you took a leap of faith. What happened there?
Well, it's funny you say that, because we started effectively as another exploration company. And after 2 years, I was writing the annual report, and I went into my partner's office and I said, Seymour, all I have to say to our shareholders is that we're losing their money. I said, we've drilled here, we've drilled there, and we've done nothing. We're going to have to, do another fundraise. And it's the same story over again. And I said, you and I are the two largest shareholder. This is stupid. We gotta think about another way to do business. And it's in that conversation that Seymour just kind of floated. He said, well, in the oil business, there are royalties. Aren't there any in the mining business? Because if there are, we could maybe buy one and have cash flow so we can sustain ourselves. And I said, well, I've heard of a few, but you know what? Why don't we give it a go? And this is really the genesis of the idea. And then I mentioned to our geologist in Nevada that we were looking for royalties. And then 3 months later, there was a box ad in the Reno Gazette. It was royalty for sale. And he gave a call. He called me. He said, Pierre, I think I found your first royalty. And to make a long story short, that turned out to be the $2 million that I paid for the Gold Strike royalty, that then Barrick came in, bought the property 2 years later, founds 50 million ounces of gold, and that royalty has paid out over $1 billion.
You entered the space actually in the 80s at a time when gold was on a long-term secular decline in prices. First of all, was this something that you had in the back of your mind? And second, how did you beat this? You still were able to be successful, despite this bear secular trend.
Well, yeah, but David, the gold strike ore body, again, I'll tell you, after the discovery, Seymour and our stock had gone from 65 cents to $17. So we said to ourselves, why don't we put a few bucks in our pocket and sell the company and then do it again? And I was at the Holt McDermott mine opening in Northern Ontario, and Brian Meikle, who is the discoverer of Gold Strike, was there. And I said to Brian, I said, well, here's what we're going to do. We're going to sell Franco-Nevada and we're going to do it all over again. And he looked at me and he said, you don't know what you're doing, do you? And I'm thinking, what is it I don't know? We're going to put so much money in our pocket. He said, Pierre, this is not the discovery of a lifetime. This is the discovery of 3 lifetimes. And he was right. And that's why we were so incredibly successful in the 80s, because, after the discovery, the growth was, continuous, and it helped us really create the company that it became.
Pierre, I have one last question for you. You've built so much over your career, and you've talked about helping young entrepreneurs. What would you say to somebody who wants to build the next Franco-Nevada? You look around at all these streamers now that have followed your model. What would you say to the executives now who are either running a streamer or somebody who wants to start an exploration company?
It's always the same thing. I've made money with people. Good people make good things happen. And if you are starting your company, hitch your ride with someone that's already created value, that's already discovered that, that discovered an ore body. And pretty soon you'll find that you will yourself come up with ideas on how to create that value. But it's all about people. Good people, good things.
Pierre Lassonde, that was a fascinating talk. I want to thank you so much for your time today. I really enjoyed speaking with you.
Thank you.
I hope we have you on again. Thank you for watching the Precious Metals Summit. We'll have more coverage for you. I'm David Lynn of Kitco News. Stay tuned.